Got it.
All right, we're ready.
We're live.
All right.
Okay, good.
Good. So I'm Tom Curtin.
I'm Joanne Curtin, and we are about to share with you our Creating Wealth Through Real Estate, Millionaire Real Estate Investor Workshop. And a lot of the principles and models that we're sharing with you in these slides come from the Millionaire Real Estate Investor book, which we'll show a photo of. But anytime you go towards financial, want to acquire financial wealth in your life, you really need to look for the fundamentals and the models that help drive that. So that is the whole intent of these slides. And we follow them, and we're happy to share them with you now. So let's get going.
All right, I'm going to share my screen.
Perfect. Yeah, there's the book. So this is the Millionaire Real Estate Investor book. I highly recommend you using this as a resource, a guide, a reference book. You could even kind of get a spine put on it so it's easier to flip through and look at. But this book, I always like to share. Criteria is the most important piece when you're investing, because if you
what do you mean by criteria?
Well, okay, so if you had $1 million, what would you buy? Okay, that's the big question. If you had $1 million, what would you buy? And if you don't know what you would buy, then you don't have criteria. So when you have criteria, it becomes real clear if you see what you want to buy. So that's what this Millionaire Real Estate Investor book is so important about.
You're just jumping into the meat and potatoes.
I know. I love that.
All right. All right. So, so Joanne, what caused you to start thinking about investing in real estate?
Well, so I mean, I got into real estate to build wealth through real estate, and I mean, it was about freedom and having the choices to, you know, having the time to choose what I want to do with my day. Instead of, you know, instead of working for money, I wanted money to work for me so that I had freedom. So that's it.
Okay, so before we jump into all this, I guess, quick background. Joanne and I met at the University of Georgia, go Dogs. We have 2 children, Carver and Willow, 2 dogs, not photoed here. And Joanne actually got licensed in 2001. So like she said, starting out, I think we've got a slide coming up, read the Rich Dad Poor Dad book, got inspired and started selling. I joined her in 2002. And 2003, we launched the Keller Williams office here in Roswell. And then we moved into this office where we're giving this presentation from on Canton Street in Roswell in 2017. And then 2018, Curtin Team Cares started. Yeah,
that was a big move. Tom was a big creator in that endeavor, but we started a 501(c) to give back to our community where we felt like help was needed the most. And as a first grade teacher, and just being a teacher period, it became real clear of some needs in our town for some schools, children, and the teachers. Yep. So we are enjoying supporting some local schools.
And we have, you know, built a real estate investment portfolio as well. Still learning. We're still in classes ourselves, learning from people who have gone down the path further than us. So we just hope to give, you know, some models and what's worked for us here, in hopes that that might help you either go further on the path you've already started or get started on this path.
Well, and agents on our team and clients that have taken this and at the end of it have literally, you know, bought a property because of these slides. So that's a little bit of a warning. Watch out if you really want to go through these slides.
Might buy a house. Right. So I think it's important to start with kind of overall economics, what's going on in the real estate market. This is a graph that goes all the way back to 91 showing home price appreciation. It's really interesting because it's got the trend line. This is the normal long-term average appreciation over the course of a long time, has averaged at 4%. So that yellow trend line shows a 4% trend line. And back in, starting in like 2007, we started to get above that trend line. We all know what happened, in like starting in 9 and 10 when the market then started to retract. But what's interesting is there was this gap from the trend line for a long time, right? So all the way up until 2019, we were still below all that equity that was given back during that great recession, when the downturn happened. We still had a gap. So, even though prices shot up, what felt like they were shooting up starting in 2019 and into 2020, it was really just starting to close that gap that existed. And now you can see, we've gotten above the trend line. So the market always wants to come back to that trend. So we're starting to see some retraction with that now. Oops, on the wrong way. So
it's a great one. This is a great one.
What's driving a lot of this, obviously inflation. We keep hearing about inflation in the housing market, inflation in everything across the board. We've just seen, and 2% is where the government would love us to be. And we're just not there yet. So they're using the mechanisms that they have at their control to try to cool inflation, one of those being housing. So this is where we're at. Again, going back to, I'm not sure where this goes back to, 2000. Yeah, anyway, going back 20 years or so, this just shows you annual home sales. This year, we're projected to end at 5.1. It could even be a little bit less than that. But you can see last year we were at 6.1, which is high, but it's not as high as where we were the last time the market kind of went crazy. And I will say there's actually more. The population is higher, right? So relatively speaking, that inflation of that market back in 2004, 5, 6, the run up prior to the pullback, was really even a bigger run up with that many home sales happening.
Because all the millennials are able to purchase properties, so that's why there's so many more purchasers coming into the market.
Yeah, there's more population. Mortgage rates as of today. This is from September graph, monthly graph, going back to 2015. So, it got corrected. The government was trying to stimulate the economy with COVID and leading up to that. So rates went super low. I don't know that we'll ever see those rates again in our lifetime. But now they're sitting, actually as of today, they're sitting around 7%. So this is one of the only tools that the government has to try to cool inflation, is to continue to raise interest rates and actually try to slow the housing market down and slow housing prices down. So we're definitely seeing the effects of that higher interest rates.
Yeah, I was going to say, as far as the the activity out there, it's there's a lot of advantages right now because there's more inventory.
Next slide.
Yeah.
Right. So I mean, that is kind of the story. Inventory is way lower than normal, even with we're starting to see more inventory be on the market. And people are noticing that. And I think it's just one of those things that we were going 120 miles an hour and now we've slowed down to, 55 miles per hour. So everybody feels like it's slowed way down, but we're not even at normal inventory yet. So there's still a lack of enough inventory in the market. And I'm going to get kind of ahead of myself, but that's one of the reasons that I feel like it's still a great time to invest, because there's a lack of housing in general still for the demand and the need, and particularly rental housing, there's a lack of still. So
yeah, and I mean, real estate, it doesn't move super fast. Back in the Great Recession, when home prices were slowing, people weren't like, oh my gosh, I can't believe I paid I reduced my price so much. And that continued. And it just was the same when people said, I cannot just believe I paid full price for that house. Well, it doesn't go away overnight, it continues. So the shock and awe still has time, months, years to flush out.
yeah.
So we can all see what's coming. We get, we don't have it super hot, super low overnight.
Yeah.
So.
So people may ask, some people may say, why do you talk about wealth? Like, why,
Why does wealth matter?
Why does it matter? Why does it?
So this is one of my favorite slides that I've learned from in seminars. And this slide is all about if the land mass in the United States were divided like the US wealth was. This is why wealth matters. Because obviously it's, people have their unfair share of wealth.
That's a great visual.
Yeah. So I'm not going to explain the graph, but basically 40% of the population would own that little bitty red dot at the bottom, which is just a huge aha. Yeah. It's a public service announcement. It's kind of what I like to share with that slide.
Yeah. So another great graphic. This is from a couple of years ago, but we've looked at it and I think it still holds pretty true. What always jumps out to me on this one is, just how few people actually have that $1,000 emergency fund, which, that can really wreck you. If you don't have that saved, and, 78% of people living paycheck to paycheck, that's pretty scary, right?
Yeah. So it's not that wealth just matters for wealth, but you don't know what the future holds. And it looks like from this that we're one emergency away from not having anything. Yeah. So we're
I think that's the point, is you don't know what you're going to need. You don't know what your family's going to need, so, there's just a lot of reasons to plan for this.
Oh, all right. So here's the Rich Dad, Poor Dad. I love this book. We read this book to my son when he was young. We really need to read it again. I love this book. So I read this book when I was a teacher teaching first grade. That's a picture of me in North Carolina, Tryon to be specific, in the mountains of North Carolina. And after I read the Rich Dad, Poor Dad book, I was like, wow, I need to put some gas on this process. And that's what drove me to get into real estate, because I wanted to build wealth through real estate. And that was it.
Yeah. So then Joanne had me read the book, I think, after she read the book, and that's when we moved back to Georgia and Joanne got real estate. But I think we say it starts with mindset, because the Rich Dad, Poor Dad book, I would highly recommend it if you haven't read it, but it's not a how-to, but it's just more the whole mindset around passive income versus, working and earning active income versus passive income, right? So there's lots of different definitions of financial wealth, and the one that we've landed on is the unearned income to finance your life's mission without having to work. So passive income is what I would call that. This is from Rich Dad, Poor Dad, and he also wrote another book called Cash Flow Quadrant. And there's 4 ways to produce income. The first is as an employee, where you have a job. You're basically trading your time for money, right? Straight time for money. There's no leverage. 5% of the population of the wealth in America that comes from employee wealth. Self-employed would kind of be the next quadrant to move to. That's where you still have a job, but you own the job. So again, you're still trading time for money. If you're a single agent, like Joanne was when she started out, she was, whatever she put in, that's what she was getting back. She was trading time for money. She was self-employed, she worked for herself, but it was still a straight, no leverage time for money. Then moving over to the next quadrant, that upper right quadrant, business owner, that's where you have a system, right? So now you've built out the system, you hire other people to help work with you, and you're able to leverage more. So your income doesn't depend on 100% on your active work. You're leveraging other people's work, and you're trading, some investing in your time, but you're also investing money in people and getting return from that. And then the last bottom quadrant is the investor, where you own investments, right? And your money works for you. Like you said at the beginning, you want your money to work for you. So it's working, ideally it's working around the clock while you sleep. It's earning a return all the time. And that's what a great investment will do for you. So financial wealth, again, the unearned income to finance your life's mission without having to work. And passive income doesn't mean you don't put any time in, but it gives an unproportionate return on the time you've invested. So your income loses correlation to your hours. So the example I use with buying a home is, in the beginning, you put a lot of time and effort in, with finding the property and then potentially fixing up the property, finding a tenant. All of that stuff takes a lot of time. And when you look at your return initially, it doesn't look like that much, but we're going to get into all the details on how you gain over time, long-term, with doing that. But your time or your income over time kind of loses correlation to those hours that you initially put in, right?
Time well spent.
Oops. Keep going on. All right, so this is an example of really why you can't save your way to financial freedom. So let's say your goal is to create $100,000 passive income in a year. You'll need, at a 4% return, right? Let's assuming you're getting 4% and you're not being taxed on that, which is another thing. So let's assume you're getting 4% return. You've saved all this money, it's in the bank. If it's getting 4% at $2.5 million, it's giving you back $100,000 a year passive income. That sounds great. So and let's say you make $100,000, for easy math, you make $100,000 a year in your job, right? So you're going to take that money and you're going to save it. So you're going to pay $30,000 in taxes, right? 30%. And you're a super good saver. You're going to put 30% away. So you're saving $30,000. That leaves you $40,000 to live. So after 10 years, you'll have 300,000 saved. 20 years, 600,000. Say 40 years, 1.2 million. After 80 years, you'll have 2.4 million saved. And at that point, you'll be dead, or whatever. Maybe you're still alive, but that's a long time to wait.
That's a long time to wait to enjoy your 2.4 million, which is the 100,000 passive income a year.
But then, somebody's going to argue, well, I can get better than 4%, right? I'm going to do better than that. So let's say you put $100 a month away. This table just shows you, again, how long you'd have to get 20%, right? If you got 20% return annually for 30 years, if you put $100 a month away, then eventually you'd get to 2.3. So you'd almost be there after 30 years. So, but you'd have, anyway.
And that's with a 20% return.
Yeah, whoops, 20%. So it just shows you the different returns and how that would increase.
Mm-hmm.
Yeah. All right, so I like this slide. I always have a hard time explaining it for some reason, but the slide shows the difference between how the wealthy kind of handle their money versus how 80% of the population handles their money. So if you're the majority of the consumers in America they earn money, they consume first, right? And then they'll have something left over. Okay, so they consume first, they'll have something left over. Let me just close Facebook. Whoops. They'll consume first, have something left over, so that's their cash, right? Then they'll look to invest in something that cash flows. Whereas, the wealthy will take their money first, invest in something that cash flows, whatever that puts off, right? So they'll invest in an asset that cash flows, whatever money that puts off, then that's left over, that's what they'll use to consume. So it's just kind of flipping, the way they'll handle that.
Mm-hmm. That's called big hat, no cow.
Yeah. So we want to kind of dispel some myths, because sometimes people, we hear from people, hey, I don't have enough money, or only really rich people can buy real estate. So the National Association of Realtors did a study, and what they found is that the median distance from people who bought an investment property, their primary residence, was only 20 miles, right? So meaning people are buying where they live. Mm-hmm. And of those who purchased an investment property, 73% had an annual income of $100,000 or less. So, it's not that it's people that, only earn $1 million a year or more are mm-hmm. buying real estate. We really like Atlanta, or, the whole metro area. We're seeing employment growth.
Well, and now it was just named #1 place to live.
Yeah. So
that's a feather in our cap. So this is even better.
Employment growth. A lot of companies are relocating here. We're seeing a lot of technology companies come here. A lot of people have, it's a less expensive place to do business than, say, the Northeast California, Chicago even. So we're seeing a lot of great employment growth, higher income growth. And with that comes rent and price growth. Obviously, we talked about, how much homes have gone up. A lot of people moving here from other areas still feel like there's value, compared to where they are coming from. And with that rent growth, we've seen as well, there's just a lack of inventory, and that's driven rent prices up as well. So with that combination, job growth rates, vacancy rates being down, and we still have, again, relatively speaking, manageable entry prices into this market. It just makes it a really good place to invest. So we like buy and hold versus, you hear a lot about flipping, but in my opinion, flipping is just creating another job. So it's active income. I mean, you have to do something to and you have to keep doing it to create that income, versus buy and hold, where you can do just that. You're buying it and then you're holding it. So a buy and hold means you're going to hold it for, longer than 12 months.
Mm-hmm. And flipping is difficult when you're flipping it with materials that are appreciating with inflation. So
yeah, that's been the challenge.
Yeah. Right? So trying to time that market is something else.
So unlike stocks or mutual funds or money market, real estate, we say, is an able investment, right? Number one, it's never going to go to zero. And you can leverage that property. And by leverage, we mean, you can get a loan on that property. So it's accessible. Anybody can buy it. It appreciates, increases in value over time. It's rentable, so you can create cash flow from that property. It's improvable, so if you put, you can put active work into it, your own sweat equity, and make it worth more, make the value of the rent more, make the property worth more. It's deductible and depreciable, which great tax benefits if you don't understand how depreciation works. Get with your CPA, or just go on Google, right, and Google real estate depreciation, and I'm sure there's some great explanations out there. But you're basically getting to the house isn't depreciating, but the government allows you to depreciate it, and take that as a tax deduction every year on. So that's a huge plus. It's stable, meaning it's slow to rise, slow to fall most of the time. So you're not going to have dramatic fluctuations like we've seen in the stock market, or cryptocurrency, or some of these other things that aren't as stable. And it's livable, right? So at the end of the day, people are always going to need a place to live no matter what's happening. And if things really go bad, you can move into it yourself.
So make sure you buy a property that you would be actually okay to live in if you had to.
So we talked about leverage, meaning you can leverage your money on this. So this is an example of, again, using $100,000 for easy math. If you were to take that $100,000 and put it into a stock or a mutual fund or a money market or an investment property. So whether it's a stock, mutual fund, or money market, to put $100,000 in, you have to have $100,000 to start with. With an investment property, the minimum down payment is 20%, so you'd have to have $20,000. So you wouldn't have to have the full 100, you have the 20,000. So let's say you put $20,000 in. What are your carrying costs? Most stocks, mutual funds are going to have some sort of a load, or a carrying fee, a commission that's basically being paid. So that can be anywhere from 1% to 4%. Money market's not going to have that. And with an investment property, your carrying costs offset by the rent that you're collecting. And that's part of working with someone who has experience that can give you that rent range. So you understand that going in, like, this is what my mortgage and expenses are going to be. This is the anticipated rent, so they should offset. I wouldn't invest in it if you're going to be in the hole necessarily, unless you plan to personally use it like a vacation property, but that's another class. So other costs, stocks, mutual funds, and money market would have other costs. With investment property, we estimate just 10% for vacancy and maintenance. 10% meaning your annual cost, your annual rent. So let's say it rents for, I don't know, give me a number, $1,000 a month, then $12,000 a year you're collecting. Take 10% of that. $1,200 would be how much you would estimate for vacancy and maintenance annually. Income per year. So stocks have generally, over the course of the long haul, appreciated 8%. A mutual fund might be 10%, and money market, you might get 2%. With investment property, in this example, we're using 5%.
That is funny.
Well, I mean, we've seen a lot more lately, but long term, I think.
But
5%.
We've been sharing 5% for years, and that's just.
Yeah, so 5% appreciation.
When it's been 20 for the past 2 years.
Yeah. So adjusted ROI, when you deduct your costs, okay, of carrying costs and so forth, you can see investment property is 25%, so it's much higher than any of the other.
And that's with this conservative appreciation.
All right, so I'm going to show you how we did that math. So again, you're leveraging the bank's money in this case, or other people's money. So assuming the property went up 5%, it may, again, if you buy right, it could definitely be more than that. I think that's a very conservative number. But 5% of 100,000 is $5,000. So you gain 5,000 annually. 5,000 is 25% of the 20,000 that you put in, right? So if you wanted to make that same $5,000 with a mutual fund, yielding 10%, you'd have to put in $250,000 in cash, right, to get that same return. And most people don't have necessarily that $250,000 in cash, but you might be able to come up with the 20,000 or 40,000 to invest in a property. So there's a couple of ways that you make money with over the long term, increase your net worth over the long term with investment property. There's price appreciation and debt pay down. Those two things together create equity buildup.
Okay, so now I want to, okay, maybe you want to continue with these before you answer this, or you can talk about it now, but you know, there are schools of thought about buying the house completely with just cash, and then they own 5 houses free and clear, and it's putting their 3 kids through college. So why would this with debt be a better choice than just having it fully paid off?
I think that goes back to this one, right? The return on investment. So if you bought the house with cash, your return on investment would just be 5%. It wouldn't be 25%.
So it's your ROI that is actually at stake here.
Correct.
So yeah. Return on investment. Okay.
Yeah. So over time, the house, again, 5% conservatively, but it's going to go up in value. So the market value is going to rise. What you owe on the house is going to get paid down, which is paid down through your tenant, right? Paying that down through rent collection is paying off the mortgage. And eventually, if you hold it long enough, you'll pay it off, and then you'll have all that equity of the appreciated property. So that's, equity buildup is one that's going to add to your net worth. So once you, have all that equity, there's lots of things you can do with that equity. You can, again, pay it off and just take that cash flow every month free and clear, and live on, do whatever you're going to do with that cash flow. You can pull that equity out. If you pull that out through a cash out refinance of your investment property, that equity is tax free.
And that's one thing.
So you can reinvest that equity in another property or whatever you want to do with it. Or you can sell the property again, to capture that equity and roll it into, another investment property, or a couple of investment properties. Okay. Cash flow is going to grow over time too. So your equity is going up over time. Your cash flow is going up because rents are going to appreciate just like the house is appreciating. So your debt service is fixed, right? You're locking into a fixed loan for the long term. So that doesn't change, but rents are going to keep going up, which is why you want to buy a house. If you're renting, if you're a renter, you should buy a house, right? Because that puts you on a that fixes your expense, and you're not subject to rents, which are going to continue to go up, right? So, and it's not, that, oh, the landlord's greedy, he's raising the rent. Like, right, what's happening right now is taxes are going up, right? So everybody's getting their tax bills on their great appreciated house. So they've got all this equity, but that translates to a higher tax bill, and naturally the landlord's going to pass that through to the tenant. So rents are going to keep going up here in the next year for sure.
Well, and another great point is, you're probably thinking, well, shoot, I'm not going to buy anything. Well, look at the interest rates. I don't want to pay what the interest rates are. Well, and if you're renting a house and you're wary of paying what the interest rates are, guess what the interest rate is on renting? 100%. So whatever the rate is a lot less than, for renting. So that's just a perspective.
Yeah. So real estate is a long-term investment, right? So what happens is this graph, it looks more like this, because in the beginning, the equity buildup happens slower, everything happens slower. The rent appreciation just looks slower. So it doesn't, like, the straight line is not realistic that it skyrockets. It is more of a hockey stick shape. So it's just time on task over time. All right. So people invest in real estate for a couple of reasons. The return on investment, we just showed that example, it's less out of pocket for more return ROI. The tax write-offs, I mentioned the depreciation, I think it's I don't know what the statistic is, but I want to say like 95% of the wealthiest people hold their money in real estate, and it's a lot of it has to do with the tax write-offs that are available. That that's why they do it. Growing your net worth through the equity buildup. And again, I think Joanne mentioned, she has a friend who has 5 houses and they use it to pay towards college education. We have a friend who has 3 daughters that bought 3 houses to
pay their weddings.
Well, no, it was 3 houses for the college for his 3 daughters, and then he realized he needed 3 more houses to pay for 3 weddings. So now he has 6 houses. So there's a lot of ways you can do it, but that college education savings, again, it doesn't have to just be the rent that's paying it, that cash flow. If you've got enough equity buildup, you can pull that equity out, pay for college, but guess what? You still have that house. So, unlike a student loan, when you pay it off, you have nothing to show for it. At the end of it, you'd still have the house. And then anyway.
Well, that's a whole nother.
A whole nother thing. All right. So tax write-offs.
Well, let me just quote this. So a lot of the reading we were doing was a book about tax-free wealth by Tom Wheelwright. And one thing that I had written down was, he said, utilizing the tax code, because a lot of people think that's that's shady to be doing all these tax dodging. But it's he says utilizing the tax code to its fullest potential is one of the most patriotic things you can do. And that's why the government creates these rules, is because it does benefit the government. We create housing for people and we get a benefit because of that. So
yeah. So the tax write-offs, again, consult your CPA, but you can, generally speaking, operating expenses, your mortgage interest, financing costs, closing costs, depreciation, improvements that you might do to the house, maintenance expense, all that stuff can be deducted. So Joanne mentioned at the beginning criteria. So these are just some questions that you can ask yourself as you form your own criteria, and that's what we would suggest, is you determine what's my criteria. Then you can really get focused instead of just blanket statement, I want to buy an investment property. Like what, how much, first of all, how much free cash do you have to purchase it? If you just have the down payment, then we need to find a newer home that's basically rent ready, right? You can't go buy a fixer upper and not have the money to renovate, or an older home that's probably going to have more maintenance issues. Those are just things to consider. How much do you have to put into it? And
one of the criteria pieces of a friend that started this back in the 80s, because we all know what interest rates were back in the 80s. I mean, they were up in the teens. And they their goal was to do 15-year notes, because in actuality right now, if you did a 15-year note, you would get money cheaper than doing a 30-year back when the rates were so super low during the pandemic. So a 15-year could be one of your criteria.
Yeah.
Because of where the rates are right now.
Right. So strategy, are you investing for cash flow, increased net worth, or maybe both? So that's something to consider. What's your risk, your tolerance risk? And how about your tolerance for dealing with rehabs or contractors? Again, how much of a fixer-upper are you willing to deal with? Excuse me, where do you want to own it? I think once you figure that out, you can really zone in and get to know a market pretty quickly. I mean, if you narrow down, I want to be in this school district, and you start looking at property in that school district, you'll understand value. You'll know the neighborhoods. I mean, all of that you can learn pretty quickly. So it's important to geographically decide where you want it to hold your rental property.
And typically, by the other slide that you shared, that's usually 20 miles from where you live now. So that's the easy place to begin.
That makes sense, instead of crossing state lines or something for your first deal. And then how long do you intend to keep it as a rental investment? That's consideration. And then what rate of return do you get from your other investments? So, where are you maybe putting cash that you're not getting as much of return that you can get more return through investing in real estate? Determining rental rates. Okay, so we're not going to get into Airbnbs here, but obviously that's been talked about a lot. I think some of that is, more expensive than maybe people realize. Just there's more wear and tear, and the numbers maybe look good in year one, but you have to think about all the furnishings and everything else that are in there that you might have to replace. So we're not going to talk about that, but if you wanted to figure out what short-term rental rates were, there's a website called airdna.com. You do have to pay for that, but you could pay for 1 month and kind of learn the area and figure out what you need to figure out and then cancel it. Long-term, realtor.com is a great website. Obviously, if you're working with a realtor, we would be a resource to be able to tell you that. But realtor.com and rentometer.com both show rental properties, and you can see what's been rented in those areas that you're focused on. So any other resources?
I was just thinking, yeah, that's awesome.
Okay. All right, so these are just your basic residential properties, the different types. Condo, we're going to talk about each one, positives and negatives. So condos, single family homes, duplexes, and fourplexes. So condos, the pros are generally lower purchase price. The maintenance is included and there's more amenities, right? So people will look to those sometimes for those reasons. The cons, however, are the HOA fees. The HOA fees, because the maintenance is included, and you have all those amenities, they just tend to be pretty high, and they can usually eat up pretty much all your cash flow. And you only own a percentage of the land, right? And then typically there's less appreciation. Condos are usually the first to kind of fall when prices start going down, and they just don't necessarily appreciate as much as a single family home would. So single family homes, this would be our first choice probably, or it is our first choice. Easiest to resell. You're typically surrounded by other owner occupants, so the neighborhood stays in good condition. And there's more appreciation with a single family home, and tenants tend to stay longer. I think there's a couple of reasons for that. One, it's a bigger place, so they have more stuff. It's just harder to move versus a small condo where they can load it all into a truck with a friend on a weekend. It's a bigger investment for the tenants to move when they move into a house. And a lot of times, they have family, they get rooted, right? So once they're there, they tend to get a little more rooted in those single family neighborhoods. So that is a positive, because turnover is one of the things that will cost you money. It's better to kind of be slightly below on your rent and keep that tenant for a longer term and not have to deal with any turnover, than try to max that rent out as much as you possibly can, and then have somebody find a better alternative and move out. You don't really gain on that. So.
Yeah. So if you try to squeeze out another $100 per month on a house, you are vacant for 1 month because of it. You just lost out on $1,200 or whatever your rent was. So it's not a smart move to be overshooting market value.
Right. With a single family, it's one unit. So when it does go vacant, then you're 100% vacant. And that's it. Duplex would be, basically two single families matched together into one unit. So they're typically close to single family home neighborhoods. There's less risky than a fourplex that we're going to talk about. They would probably have more cash flow, but lower appreciation. So generally the equation of the cash flow is higher and the less appreciation. There's different reasons for that, but if you're buying strictly for cash flow purposes and you don't care about equity appreciation, then a duplex or a quadruplex might be the way to go, because they just don't appreciate as much. And they're usually surrounded by other rental units as well, so that's part of what keeps the appreciation from going up.
And the cash flow piece sometimes comes from people who maybe don't have a long runway to wait for that appreciation. They just want the cash flow up front because they have other shorter term plans. Sure. Versus somebody who just has a long runway.
Right. Fourplex, again, that's usually your highest cash flow. You're essentially buying the leases that are in place on that. Minimizes financial impact from vacancy. So, if you have one vacant, the other three are usually covering all your expenses. And there's economies of scale, meaning, if you replace the roof, you're replacing the roof on all 4 units. If you're, having somebody go out to maintain the HVAC units, they can do all 4 units at one time, those kind of things. The downside are, you're just attracting, there's more upkeep. It's attracting maybe a lower end tenant, where you might have more tenant conflicts, being, all next to each other like that. And they definitely appreciate less.
Well, and most times you're buying it from another investor anyway. So now you're just
100% you're buying it from another investor.
I mean, you are buying it from an investor. So now you're negotiating with that investor.
Yeah, that's right. So on the single family, if you decided to sell it, you're most likely going to sell it to a retail, highest price. So our personal preference would be kind of the lower middle market property neighborhoods. So the very low end, for us, again, you might be able to create more cash flow, but it's just more headaches with tenants, requires more maintenance. And then super high end property or higher end properties, the rent to price ratio just stops making sense, right? The rent doesn't move high enough to offset the cost of that higher mortgage. So there's kind of it's really that middle to low middle ground where the numbers all work well.
Yeah. Instead of buying that one big one, you could buy 3 small ones.
Yeah. And there's a bigger tenant pool for that than, the high end. There are people who will pay, a high monthly rent, but they're far few in between, right?
Yeah. And if it unfortunately gets trashed or hurt, now you got a lot of cost involved with getting that ready.
Right. Okay, so it's always, people were like, well, should I buy something now? Should I wait? What's going on? I mean, it's always a great time to make a great investment. So you've got to be in the game looking, to know, because there's great deals all of the time. You just have to be looking for it. You have to be out there looking. It's still a good time to put debt, even though the interest rates have gone up. Owning a hard asset like real estate is a hedge against inflation. If inflation does keep rising, so is real estate. I mean, real estate is nothing but all the parts of the house made up together. All that stuff if inflation is going up, all that stuff's going up, the house price is going to keep going up. So it does protect your money from that standpoint. And don't wait to buy real estate. Buy real estate and wait. Right.
That's awesome.
Oops. Property management versus self-management. Generally, property manager will cost 10% of the gross rent. If you want to factor that in, if you intend to have a property manager, then that expense would need to be factored in. And then for securing that new tenant, somewhere between a half to a full month's rent for that, screening process, where they'll do the marketing, showings, credit background checks, deposit collections, rent collections. They handle repair requests and then evictions if needed. So self-management, again, if it's in your local area, if you're in our local area, we'd be happy to talk to you about either of these and kind of what goes into it. But I wouldn't, people seem to get really scared about it. And I don't, just my experience, knock on wood, it's not that scary. These nightmare stories just are few and far between, right? Do you want to talk about this?
Yeah, I love this one. So, all right, so the wealth building progression, this is a mindset, and it does relate back to the Rich Dad Poor Dad book, and I'm very visual, so I love drawings instead of spreadsheets. So this drawing is just showing that, this is as if the quadrant that we shared, the employee, self-employed, business, and investor, is just put out on a line. So the one to the far left here is basically just trading time for money, and that's your job. Teaming up with others, which we do, on our team, we have a team. That is a real smart way to move towards that operating a business. Someone's recognizing that together everybody's achieving more. And so that operating a business obviously is more on the continuum of the Rich Dad Poor Dad book, with trading time with talent for money. Am I tracking right, or this is just small writing? And then the self-managed rental property, now we're taking it to another level with leveraged time, and that triple net lease commercial property is basically a flywheel where your money is creating money. And so that's pretty much the full goal, is to go from just time, in your job to a complete triple net lease.
Right. So it may be, your job, you're creating margin in your life, to margin in with your money, right? Through your job, that you're saving money to be able to then invest in, a business or real estate. There's really two ways to grow wealth. And so in the beginning, you're multiplying your money by taking it and putting it in those places, right? Ultimately, triple net lease is one of the most hands-off ways to do it, where the tenant's basically responsible for everything. The return's not as high, but it's completely hands-off for the most part. So getting started with all of this, I think the first step is to track your net worth. Simple shared spread, a Google Sheets or Excel or whatever, in one column or the first part, you have all your assets, basically anything of value. So everywhere you have money, your stocks, your 401k, if you do have real estate, the equity in that real estate,
insurance,
and then list all your liabilities, and then you take your assets, deduct what you have left, or what your liabilities, and what's left is your net worth. But I think the key with that is to visit it and track it regularly, and then if you do make a financial move, what impact does that have on your net worth, right? And then once you kind of start to see that, it's a game, right? You understand, okay, here's how I can increase it.
All right, so next steps.
Yeah.
After you track your net worth, after you do your spreadsheet.
Do that first, right? Millionaire Real Estate Investor book that we mentioned at the beginning is a great read, kind of a how-to. Talk to a mortgage professional, because you may not realize what you can do from an investment property standpoint. They may have some creative ways to, maybe you have a ton of equity in your current home, right? And can you tap into that through a home equity line or something like that, to then be able to go get another property? And of course, talk to your financial professional to see how all this ties together with your overall goals. And then lastly, would be get together with us.
Yeah, and I would say not just to a financial professional, but also talk to a real estate agent, because a financial professional may want you to put all your money into stocks,
right? And
you need to be balanced, to have different buckets. So yeah,
for sure.
Yep.
Okay. So I guess we mentioned Curtin team. We're 12 team members. We also can do some project management on these properties. So we do have home stylist that does, can manage contractors, color selection, and all that.
Especially if you're out of state and you're hands off.
We do also have Create Wealth Property Management. So if it's a local property, here in this, North Fulton, East Cobb, that kind of area, then we can help you with that. Or again, happy to walk you through the self-management part if you're worried about that and how you can do that. So that's it.
That's it. All right, thank you. We'll have to reshare this on Facebook because we were out. Thanks, guys, for watching.
Thanks.
Good luck. Reach out if you have any questions.